Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, just after the close. John Mousseau is going to be handling the market recap this week, but David Kotok and I wanted to come on and wish a happy holidays to all of our friends and clients. Quick note on the market, continued strength. Some of Dr. Leo Chen's quant work has been showing complacency to greed levels that we do need to pay attention to. David, couple thoughts?
Happy holidays. We wish everybody good health in the new year. This stock market is so strong. The dogs are rising and the fleas are rising. Everything's going up. Watch out. Things can change quickly. This celebration's wonderful today. We'll see what it brings us next year.
Great. Stay with us. John Mousseau covering bonds and a couple thoughts on equities. Have a great weekend.
Good afternoon, everybody. This is John Mousseau. I'm President and CEO of Cumberland Advisors. And they call me the Moose, and I'm with my friend here, the Moose. And we're wishing all of you out there a great holiday season. Merry Christmas, Happy Hanukkah, Happy New Year. Just a brief recap as we go on vacation starting today. And that's to say it's been a heck of a year. As you sit here today, the S&P is up a little over 30%, 31%. The total return on the 10-year Treasury is probably about 9% and change. It was higher than that, but we've seen interest rates back up a little bit. More on that in a second. But it's one of those years where both asset classes, equities and bonds, did very well. Different sinking points along the way, but as you sit here on one week left to go, it's pretty clear that it was a good year in both asset classes. It isn't always that way. If you went back some years after the Great Recession, we had years where bonds did great as yields came down and equity markets were floundering. So this is a year where people who had balanced portfolios really are able to look back and say it worked out pretty well. Where do we go from here? We think that the economic numbers are very ripe for good equity returns going forward. We have seen it in the GDP numbers, we've seen it in the durable goods numbers, we've seen it in the low unemployment rate, we've seen it in the low number of initial jobless claims, and on and on. We take great solace in that. At the same time, we think interest rates went way too low last summer, and a lot of that was the United States catching up with Europe and Japan. However, when you look at that in the rearview mirror, it's pretty clear that the low or negative interest rates that were going on overseas were not working. And the financial markets there weren't working when you look at the banks. They started to change their tune. We saw the Riksbank, Sweden's central bank, go away from the negative interest rate policy and move their floor off of negative interest rates. We think that's just the beginning. So what we see in the early part of next year is interest rates slowly rising. Really think about the 10-year bond rate working its way back to 2%, maybe over 2%, catching up with the core inflation rate, which is around 2.3. Maybe it stabilizes around there. But the backdrop is for pretty good equity markets, slowly rising yields in bond markets, which, by the way, for a total return bond portfolio is not the worst thing at all, because it means that the reinvestment rates go higher on bonds. So that's it. We wish everybody a great holiday. Thanks for your support.